What do you need to know about jointly owned properties when it comes to Making Tax Digital? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. As an individual who receives property income, you will be subject to Making Tax Digital. If you comply with the requirements, you may need to do something. Now, if you've got a jointly owned property, then you still will have obligations under Making Tax Digital if you are over the thresholds, which we've got the first one being 50,000 in April 26, the second one being 30,000 in April 27, and the final one of 20,000 in April 2028. So if your joint property income is over one of those, for example, you may have one HMO that's owned jointly, that you receive income of 45,000, which on that basis would say on that one property, which is a HMO, you're over the threshold because you own half of it and you're now 22,500. So that would mean you are within Making Tax Digital and you will have to follow the regulations. Check out the video with some of the quirks of how it fits together, and that will hopefully take you through a full example on what it means with the jointly owned property. Today we're focusing on jointly owned property because it is one of those quirks with Making Tax Digital that you will still have to do the quarterly reporting and you'll have to do the bits. So what do you need to do? So the first thing as a jointly owned property is you need to make sure you're incorporating that into the assessment when you are determining when you need to be doing Making Tax Digital. So as that brief example there with one property at 45,000 total income and your 50% being 22.5, that's definitively over. So that would be April 2028. If you've not got a HMO getting that much income, you might have a buy-to-let that you share, but you may have other properties you own individually. So you need to put all your individual ones together, your jointly owned one together to see what is your overall income. So it just forms part of your portfolio, and that proportion that is yours is what needs to be considered. If on that basis that you are over, then you will need to be reporting your part of that income on your Making Tax Digital return. One of the main things with Making Tax Digital is all about record keeping, and that we need to be recording all our records digitally. Now, one of the key things here is if you're doing a spreadsheet, you may need two spreadsheets for one person's 50% and the other person's 50%, so that you're recording each of those individually to show what is your proportion of it. Other options come down to software where you put it in once and potentially it will split it off for you, which is obviously a great way of doing things because then you only have to enter the information once. But different software works in different ways. Each quarter you'll need to do a quarterly return, which is on the calendar quarters or around the calendar quarters, because we go from the 5th of April to the 5th of July, and then we go reporting needs to be done by the 5th of August, should I say, and that keeps going forward each quarter. Now, this is a digital submission, and in that digital submission, you will do it under 4 categories of income and 9 categories of expenses, which software will obviously do that for you. If you use something like a spreadsheet or Google Sheets, you will need some sort of bridging software to enable that submission to be completed. Obviously, if you're using an accountant, you'll be able to work with your accountant to sort out how that information is being collated, how that information is put into whatever appropriate software to enable submission. One point to note is this is on a cumulative basis. So if something is for whatever reason missed off the previous submission, it will go on to the next submission so that you've got the cumulative total to date figure. You don't have to go back and be changing the previous return to update that because it's not being cumulative. It's not going and adding up to make the total by the end of the year. This will all go forward throughout the year, so you'll do a submission per quarter and then you'll complete it with a final declaration before completing all your tax return using that information, which will form part of the final declaration. This allows for annual adjustments, which you may do as part of the accounting adjustments. If you have got property overseas and you've got property in the UK, then just note that you may have to do 2 separate returns, one for your UK income and one for your overseas income, because although they're both property income, each is seen as a different type of property income, and you have to do a report per property income that you receive. Unfortunately, that doubles things up, so each quarter you'll have 2 submissions to do every quarter, and then final declarations on each of them before you can then do your tax return style final full declaration for the year. For jointly owned property, they have done some easements, as it's obviously not quite as straightforward as if you own the property as an individual. The easement will allow an individual to report property income quarterly according to the categories specified in the update notice, and report expenses annually in line with the categories outlined in the update notice. This involves only entering one number per quarter for each of the required property income and expense lines, which makes the process a little more simpler. There is also easements for businesses with turnover below 90,000. If turnover from the entire UK or overseas property business is below 90,000, the other easement can be joined with the jointly owned property. The individual can there report one income figure in the quarterly updates and report a single expenses figure annually. This would therefore involve just one entry per quarter for income and one entry per quarter for expenses. Where you are making use of the residential property interest relief, you will still need to make that as a separate line item on the report. That cannot be collated with any of the other expenses, even if the easement is used. This must specifically be a separate digital record. Whether these easements are used or not, it will probably be determined by how your record keeping is or how you maintain your records. The more digital you keep all of your records, the less likely you are to need to use the easements. If you are still a slightly more manual to Excel or simple digital process, then you may wish to use some of these easements to simplify the process for yourselves, especially if it's maybe one joint property and it's easier to do this sort of approach with a bridging type software. As we get more information on how jointly owned property is impacted by Makingtaxdigital, we'll put more videos on the channel so that you can just keep up to date with what you need to be doing for your Makingtaxdigital requirements. First step I would definitely say that you should be doing now is check out when you will be kicking off needing to fulfill these requirements, and then you can start doing the planning, and check out the video on what Makingtaxdigital software to be using, what you need to be considering to find what is going to be the best option for you. Hopefully today you've discovered some of the things you need to be aware of when you have jointly owned properties when it comes to Makingtaxdigital. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel, and let's make tax less taxing. Let's make tax less taxing.